Hey everyone, me again, Devin Coombs, CPA, MBA, lecturer at San Jose State, and also a consultant in the Bay Area and ex-Deloitte and ex-Google. So just doing a ton of fun stuff. Today, I'm trying something very different. I have a case study for all of you that would mimic what a great CPA, CFA, or college level finance exam would be like. And that's going to be in the links, that case study. I'm going to go through that case study and explain it using Notebook LLM and other AI tools to show the power of these tools for education. I really aim at being at the cutting edge of education, and I really want to try to encourage you all to use it. So I'll have the Notebook LLM I used in the chat description below, along with any other AI tools. And I'm teaching my students how to learn these AI tools as we go throughout these lessons. So feel free to join the journey with us. So read the case study attached. You can use the AI tools attached in the description below. If you have questions or want more cool practice examples of how you could use AI to learn or use AI for business consulting or finance consulting, write in the comments below, subscribe, and then let's watch this video explainer, and then I'll jump in and out of the video as needed to clarify any of the facts. I really hope you enjoy it, and let's dive straight into it.
You can think of a company's financial statements like a book. It's a story written in the language of numbers. All the plot twists, the strengths, the hidden dangers, it is all right there. The big question is, do you know how to read it? Today, we're going to teach you the language. We're going to learn the grammar of finance, financial ratios. So, here's our game plan. We'll start with the raw numbers, the basic data. Then we'll go chapter by chapter through Innovate Corp's story. We'll look at its ability to pay the bills, how much it relies on debt, whether it's actually making money, and finally, how the stock market feels about it. And at the end, we'll put it all together for the final verdict. Okay, first things first. Every single financial analysis, no matter how complex, starts right here with the two most important documents a company has, the income statement and the balance sheet. This is our source material, our ground truth for everything we're about to do. First up is the income statement. Think of this like a performance report for a specific period, say the last year. It starts at the very top with revenue. That's all the money that came in the door from sales. Then it subtracts all the different costs of running the business. What you're left with, way down at the very bottom, is the famous bottom line, net income. And for Innovate Corp, we can see that's a nice healthy profit of $184,000. Next, we have the balance sheet. Now, this is different. While the income statement covers a whole year, the balance sheet is like a snapshot, a financial selfie on one specific day. It shows us two key things. Everything the company owns, we call those assets, and everything it owes, which are its liabilities. The difference between the two? Well, that's the value that belongs to the owners, the shareholders' equity. Now that we have this raw data, the real analysis can begin. Our first test is all about liquidity. This is probably the most immediate nuts and bolts measure of a company's health. The question is simple, but it's absolutely critical. Can Innovate Corp pay the bills that are coming due soon? To answer that, we're going to calculate something called the current ratio. It's a simple but really powerful test. It just compares a company's short-term assets, stuff it can turn into cash pretty quickly, to its short-term debts. As a rule of thumb, a number over 1.0 is a good sign. It suggests you've got more than enough cash on hand to cover your upcoming bills. So let's run the numbers, and we're pulling these directly from our balance sheet. First, we look for total current assets. There it is, $200,000. Then we find total current liabilities, which is $100,000. The math here is pretty straightforward. 200,000 divided by 100,000 gives us a current ratio of 2.0. So what does that mean? It means for every single dollar Innovate owes in the short term, it has $2 in assets ready to go. That's a very, very healthy position to be in. But wait a minute, what if a big chunk of those assets is just inventory sitting in a warehouse that's hard to sell? For a much stricter, more conservative test, we use what's called the quick ratio. You might also hear it called the acid test. It's the same idea, but this time we're going to pull inventory out of the equation, because let's face it, that can be the hardest thing to turn into cash when you're in a pinch. Okay, back to the balance sheet. We start with that same $200,000 in current assets, but this time we subtract the value of the inventory, which is $70,000. That leaves us with $130,000 in really liquid assets. We divide that by the same $100,000 in current liabilities, and we get our quick ratio, 1.3. And this is just a perfect illustration of why we use different ratios. The current ratio of 2.0 looked fantastic, but the quick ratio of 1.3 tells us something even more powerful. Even if Innovate couldn't sell a single thing from its inventory, it still has more than enough cash and receivables to cover all of its short-term bills. This company is on very solid ground. Okay, so we've zoomed in on the short term. Now let's zoom out and look at the company's long-term strategy. This next section is all about leverage, and that really boils down to one word: debt. How much of this company is being funded by lenders versus how much is funded by its owners? The debt-to-asset ratio gives us the big picture view. We go to the balance sheet, we take the total liabilities, that's $250,000, and we divide that by the total assets, which is $500,000. The result is 0.5. This tells a very simple story. Exactly half of everything Innovate Corp owns was paid for with borrowed money, 50-50. Now, for another way to look at it, we can check the debt-to-equity ratio. We take that same $250,000 in total liabilities, but this time we're going to divide it by the total equity, which, what do you know, is also $250,000. The result is a perfect 1.0. This means that for every single dollar the owners have put into the business, creditors have put in $1 of debt. It's a perfectly balanced capital structure, which is often a really good sign of stability. So the company's foundation looks really stable. But the big question remains, is it actually making any money? To figure that out, we need to look at its profitability. And for this, we're going to switch our focus from the balance sheet back over to the income statement. We'll start at the top with gross profit margin. We take the gross profit of $400,000 straight from the income statement, and we divide it by the total revenue of $1 million. That gives us 40%. This number tells us how much profit Innovate makes just on selling its products, before we account for things like salaries, rent, and marketing. But of course, the ultimate test is the net income margin. After every single expense is paid, from taxes to interest to salaries, how much is actually left? We take the bottom line, that net income of $184,000, and divide it by the top line, that $1 million in revenue. The result is 18.4%. Think about that. For every dollar of sales, almost 18.5 cents drops down to become pure profit. That is a very, very solid margin. Now for a really fun one, and one of the most powerful metrics out there, return on equity, or ROE. This is where we connect our two big financial statements to see how well the company is using its owners' money. We take the net income of $184,000 from the income statement, and we divide it by the total equity of $250,000 from the balance sheet. The result is absolutely stunning, 73.6%. Seriously, let's just pause on that number, 73.6%. This is the absolute star of the show so far. It means for every dollar the owners have invested in this business, the company is generating almost 74 cents in profit this year alone. To give you some perspective, a lot of great companies are happy with an ROE of 15 or 20%. This is exceptional. It signals a business that is running incredibly efficiently. So we know the company is liquid, it's well-structured, and it's wildly profitable. But what does the rest of the world think? How does the stock market feel about Innovate Corp? In this last section, we're going to connect the company's internal performance to its external stock price. First, we've got to calculate the earnings per share, or EPS. This basically breaks down the company's total profit on a per-share basis. We take the net income of $184,000 and divide it by the 100,000 shares of stock that exist. That gives us an EPS of $1.84. You can think of this as your little slice of the profit pie if you own just one share of the company. Okay, so the company earned $1.84 for each share. The next question is, how does the market value those earnings? We figure that out with the price to earnings, or PE ratio. We just take the current stock price, $46, and divide it by our EPS of $1.84. We get a PE of 25. This means investors are willing to pay $25 for every $1 of current profit. Now, is 25 high or low? Well, to know that, we have to talk about growth. We use the PEG ratio for this. We take that PE of 25, divided by the projected growth rate of 10%, and that gives us a PEG ratio of 2.5.
So the one call out here, all the ratios look great, but the PEG ratio was a little high. And so I'd expect a higher earnings growth rate in order to justify such a high price. I would actually not buy it at this price unless there was some kind of value proposition that would increase the earnings growth rate.
Generally, anything over 1 suggests that investors are expecting big things in the future, and they're willing to pay a premium for that growth today. And there we have it. We've looked at Innovate Corp's liquidity, its debt, its profitability, and how the market values it. We've read every chapter of its financial story. So now it is time to put all of these clues together and deliver our final verdict. You know, when you lay it all out like this, the picture is remarkably clear and consistent. Innovate Corp has strong liquidity, it can easily pay its bills, it has a perfectly balanced leverage structure, its profitability, especially that incredible return on equity, is just off the charts. But remember this, and this is probably the most important part of our whole session today. This analysis is just the starting line. The ratios are fantastic because they tell us what is happening. We know there's high profitability. We know there's strong liquidity. But the real job of a smart investor or a manager or anyone in business is to take this information and ask the next most important question. Why? Why is the ROE so high? What's the strategy? That's where the real story begins.